My name is Jason Bellevue. I am now the incoming president for California Association of Mortgage Professionals. The current president, Dale DeGennaro, is not able to make it today, but we thank Dale for helping put this all together. Let's talk a little bit about CAMP. Why CAMP? Well, one of the reasons is because CAMP does stuff like this. We have an education series, which you can also find on YouTube under California Association of Mortgage Professionals, where we try to do presentations on a monthly to bi-monthly basis, where we try to bring you informational and educational material to help you with the process of doing loans. The other thing that is very important is we're your advocates. On the 7th of this month, we were in Sacramento talking to senators and assembly people with regard to the legislation we believe is, number one, beneficial, or number two, would be an issue to our industry. And we are your voices in Sacramento. We also joined the National Association of Mortgage Brokers in DC. We're your voices in DC as well with regard to California representation. We're here to support you, and that's why CAMP. It's a wealth of a network of individuals who can do a lot to help you if you have questions or if you have things that you need help with. I'd like to introduce Christina McDonald. She is our education chair, and I'll let you take it away, Christina.
Thank you, Jason. I really appreciate it, and congratulations on being our new incoming president. Like Jason said, Dale DeGennaro, who is actually our state president, was not able to make it today. I wanted to introduce a very special guest today, and it's Esther Yamashiro. And she is the Housing Program Officer with HUD at the Center for Homeownership in Santa Ana, and is responsible for education and an outreach specialist with focus on single-family FHA programs, facilitates participation in local, regional, and national conventions, serves as a panel speaker at the housing events for local, state, and federal government representatives today, which is super exciting. I think this is going to be a really great event today. We'll be sharing, giving an in-depth overview on 203K Rehabilitation Loan Programs, detailing both standard and limited 203 programs, eligible and ineligible improvements, and what can be financed and what documentation is required. So with that, take it away, Esther. Thank you so much.
Thank you, Christina. Thank you, Jason. Let me first try to get my screen share going. So it says I'm sharing, am I?
You are, yeah. Looks good.
Okay, great. So I just want to let you know this is a packed presentation. I have 68 slides. Not all of them have content, but I have 68 slides. And so it's going to be a wealth of information. I hope there's going to be a few minutes left at the end to answer your questions. I'm going to ask you to hold your questions or put them in the chat. I'll get a copy of it. And if I can't answer all the questions, I will follow it up with a response document so I can get all your questions answered. And that way I won't miss anybody. So if you could please put your questions in the chat, and I will answer as many as I can in the time allotted. And so I'm going to get started right now. So we're going to take a look at the 203K Rehabilitation Mortgage Insurance Program. Some of you might be familiar with it. Some of you may have never heard of it. Some of you may be terrified of it. And I hope to alleviate some of that terror because it's a great program. And it's really underutilized. So let's get started. We got a lot of ground to cover. Okay, advance. There we go. Okay, this is our standard disclaimer slide. If any information within the presentation differs from anything in the handbook or subsequent mortgagee letters, the handbook and the mortgagee letters will always win. We try to be as accurate as possible, but we are only human. So if it's in a battle between the presentation and the handbook, you go with the handbook. This is a slide. Most of it's not relevant to you. Again, the only thing would be the cameras. Please use the chat function. And yes, I will be providing a copy of the presentation so you all can have one and to refer back to. So here we go. Let's start with a program overview. So FHA's 203K program is the primary program for rehabilitation and repair of an existing residential single-family home. That would be 1 to 4 unit structures, includes condominiums, and 1 to 4 unit mixed-use properties. So please note that the 203K mortgages must comply with the 203B requirements. They underwrite just like a 203B, except where we specifically note. We'll review the aspects of the 203K program as they differ, and one of the unique features is the HUD-approved 203K consultant who assists the borrower in meeting the specialized requirements of the program. Now, the program can be used in several ways. The first one, probably the most, one of the most popular, is that the borrower can purchase a dwelling and its land and obtain the funds to repair or rehabilitate it, rehabilitate the dwelling all in one package. Okay, so it's a single loan, not two separate. Now, a borrower can also refinance the home that they live in, and if current liens exist, they'll refinance it just like they would refinance any other loans secured by the property, and include the cost of the rehabilitation. 203K can also be used to prep a borrower's currently owned property for sale and complete necessary improvements. Now, another unique feature is that the program can be used to purchase a stick-built home on one site and move it to a new foundation at another site. Let me just stress that this only applies to stick-built structures. It does not apply to manufactured housing. I'm sure most of you know you cannot get FHA insurance on a manufactured home that has been relocated from a site other than the builder, the manufacturer. Okay, and we'll take a look at other eligible improvements a bit later in the presentation. Okay, so again, benefits of the 203K program are that a homeowner can refinance their existing loan and fund improvements while staying in the home. A buyer can purchase a home that needs extensive rehabilitation, relatively minor repairs, or they want to modernize it and make the improvements all after closing. The improvements increase the property's value and builds the owner's equity. We all like that. The 203K program also conveniently combines the home loan and the cost of renovation into one mortgage and one closing. So no purchase loan, rehabilitation loan, and then they try to get permanent financing all in one thing. This is all one loan from the get-go. Now, the borrower must meet the standard FHA 203B, the regular forward mortgage eligibility and credit qualifications. Now, you can find these basic eligibility criteria in Handbook 4000.1 in the underwriting section. The upfront mortgage insurance and the monthly mortgage insurance premiums are also the same as a 203B mortgage for most 203B mortgages. So it's still that 1 3/4 upfront, and then the applicable premium on the monthly that we publish depending on the how the loan is packaged. Now the property is a little different. It's not required to meet FHA's minimum property requirements, MPR or MPS, at the time of closing, if, big if, the rehabilitation or repair work performed will complete and correct such issues. Now, there are two types of 203K loans, the standard and the limited. The guidance for each is presented in different sections of the handbook. Most of the guidance relates to both how the program works and things like that, general program requirements. But there are things specific to the standard and other things specific to the limited in the handbook, and those are broken out separately, so you know where you're at when you look it up. So let's cover in detail what's required, and we'll do that in a few slides, but let's finish the eligibility portion. Now, the 203K can be used with other programs, and one of those that we're going to focus on right now, which may be especially relevant, especially for those trying to rebuild from the LA County fires, the Palisades and Pasadena and Altadena fires. And that is the 203H, Mortgage Insurance for Disaster Victims Program. So this is one of the primary programs, and it allows the borrowers to utilize this program if their properties were destroyed in a presidentially declared major disaster area. So they have a year to apply for under the 203H program. They have to get their case number within 1 year of the disaster declaration, and that can be found on the FEMA website. Now, if they're using the 203H disaster program in conjunction with a 203K loan to rebuild, the loan limits and the LTV calculations and restrictions for the 203K will take precedence over the 203H limits. Let me just plug that the 203H allows you to them to purchase a home at 100% financing. So I can give you more information that some other time. But anyway, let's move on. Okay, so quick summary. We just covered the following information on the overview. 203K is FHA's primary program for rehabilitation and repair of existing 1 to 4 unit residences. 2 types of programs, the standard and the limited, and you can use it in conjunction with the Section 203H mortgage insurance for disaster victims. Now we're going to move into eligibility and application requirements. So when you get a copy of the presentation, these handbook references are for your convenience on where to find the information related to these individual topics. Okay, so the 203K borrower must meet the same eligibility requirements as 203B borrowers, and all that can be found in the handbook. A party who has a financial interest in the mortgage transaction, such as the seller, builder, or real estate agent, may not be a co-borrower or co-signer. Okay, there may be some limited exceptions if they are a family member in that situation, but generally speaking, if they're party to the transaction, they cannot be involved in the mortgage. Now, property eligibility. To be eligible for a 203K program, the property must be an existing property, and it has to have been completed for at least 1 year prior to case number assignment. If it's kind of right there on the bubble, you're going to need to get a copy of the certificate of occupancy or the jurisdictional equivalent, because not all jurisdictions issue a certificate of occupancy. You need to make sure that you have that 1 year before you order the case number. Now, if you're refinancing, if your borrower already say they bought the house and they got a 203K to modernize it a little bit. They wanted to do some things before they moved in. That's great. Now they want to refinance it and do other things and use a 203K mortgage. If that is the case, the original 203K escrow for the repairs, basically the work has to be completed and the 203K escrow account has to be closed out in our systems, or you will not get a new case number. Okay, so And FHA, we at FHA cannot close out that escrow for you. So if they got their mortgage with a different lender and now they came to you, you may have to track down where that loan is being serviced and find the original mortgagee, because that 203K has to be closed out in FHA Connections before you can get a new case number. Okay, so acceptable property types: 1 to 4 units, single family structures. This includes condominiums, site condos, manufactured housing. We even do mixed use properties, and this program is works especially well with HUD REO properties. Now, one of the acceptable property types is, of course, the 1 to 4 unit structures, which includes condominium units. And there's essentially no difference in the eligibility requirements for a 1 to 4 unit single family structure under either 203K plan, so standard or limited, as it compares to the 203B program, except for the age requirement. Remember, the property has to be completed for a year. Now, site condominiums, I'm not quite sure why they felt they had to point out site condominiums, but I'm going to go with it. A site condominium refers to a condominium project that consists entirely of single-family detached dwellings that have no shared garages or any other attached buildings, or a condominium project that consists of single-family detached or horizontally attached, that would be a townhouse style, dwellings where the unit consists of the dwelling and land, does not contain any manufactured housing units, and is encumbered by a declaration of condominium covenants or a condominium form of ownership. I think they updated the definition. That's probably why this slide is in there. Now, particular to condominiums, the subject property project must be FHA approved or have single unit approval before you can get a case number assignment. Okay, it's very important that when you order the case number, the correct project phase number ID, correct project ID number is used when requesting a case number. So FHA will insure mortgages on condominium units in approved condominium projects that have been approved both by HUD as an HRAP or by lenders as DELRAP. So either approval works. They'll also insure units approved in accordance with the single unit approval process, or they have to meet the definition of a site condo. Okay. And the handbook references on the slide will take you to our condominium requirements in the handbook. So manufactured housing, it's transportable, right? It's transported whole to the site. Among other requirements, it must be a one-family dwelling, be built and remain on a permanent chassis, and have a permanent foundation. Modular housing and manufactured housing are not the same thing, okay? For manufactured housing, a 203K, the repairs cannot affect the structural components of the house. The manufactured home must comply with all manufactured home requirements and must be constructed in conformance with the federal manufactured home construction and safety standards. So you're still going to need an engineering cert. It's going to have to be affixed to a permanent foundation, and it has to be taxed as real estate. Okay, mixed use properties. I know around here in Orange County, we're seeing more and more mixed use communities. So mixed use property can house commercial, residential, retail, office, and parking spaces. in accordance with FHA's definition of mixed use. Now, a mixed-use property is acceptable for 203K rehabilitation, provided the structure is 1 to 4 unit residential, and it is a requirement that 51% of the gross building area, that's the gross building area or GBA, is reserved for residential use. Okay, so the majority has to be residential. In addition, the commercial use may not affect the health and safety of the residents. You can't use it for hazardous activities. So you can't be running, like, for example, a dry cleaning service attached to your residential unit. You'll need to calculate the GBA to determine if 51% of the building is reserved for residential use. You can calculate the GBA by measuring the entire floor space of the building. The GBA includes unfinished and finished non-living areas, okay, such as unfinished mechanical areas, laundry areas, entryways, stairs, unfinished storage, etc., and any commercial space in the building. So don't use the gross living area, because the gross living area would only apply to the residential areas of the property. Now, I mentioned that 203K is great in connection with a HUD REO property, and they are eligible for 203K financing if the property is identified as such in the sales contract. And I'll give you an example on the next slide, or an addendum. Investors can't make use of this. Okay, they're not investors are not eligible for the 203K financing. Now, the mortgage can be used with the Good Neighbor Next Door property and the $100 down programs. They must be owner occupied or meet the eligibility of a HUD approved secondary residence. Okay, so when you're looking at a HUD REO contract, sales contract, you want to make sure, number 4, the correct box is checked. You want to make sure that this box is checked if you're using it for a HUD REO property, because if it's not checked, you're going to have to go back and get it changed and an addendum issued. Okay, on a 203K, in addition to the 1003 application and the HUD 92-900A that the borrowers have to sign, they have to sign a HUD 92-700A, which is the 203K borrower's acknowledgement. Okay, this form is very important, and I recommend that if you're going to do 203K, you get your hands on this document and you review it, and that you can go over it in detail with your borrower, because it contains the rights and responsibilities of the borrower and all the parties involved, basically how a 203K works. And you trust me when I say you're going to want everybody to know what their rights and responsibilities are. Okay, so I recommend that you go over it and you know it backwards and forwards, so you can explain every line to your borrower and make sure they understand what they can expect going forward and what's expected of them. So, quick summary: we just covered eligibility and application requirements. The borrower meets the same eligibility requirements as a 203B mortgage. We went over the acceptable property types: 1 to 4 unit single-family structures, including condominiums and site condominiums, manufactured homes, mixed-use properties, and HUD REO properties. And remember, modular and manufactured are not the same thing. I can only imagine that when they were developing this presentation in headquarters, they must have run up against that modular and manufactured issue a lot, which is why they harp on that. So anyway, let's get started into the meat of the program. We're going to take a look at the standard program first. Okay, the standard 203K has the following requirements. The eligible improvements have to be a minimum of $5,000 in repairs. FHA 203B credit and cash investment requirements apply. 203B property guidelines apply unless otherwise stated. An FHA 203K consultant has to provide services in regards to a standard 203K loan. And the fees and costs related to the renovation can be rolled into the loan amount. Okay, I know this looks like a lot, but I'm going to go through it. And remember, you'll be able to get a copy of the presentation and have this you can use this as a reference. But these are the steps in the origination process, or what we kind of believe to be the best outline of what the origination process would entail. So after careful research, the borrower selects an FHA approved mortgagee. There is no special approval from FHA for mortgagees to do the 203K loan. If you're approved for foreign mortgages, you can do 203K mortgages, okay? Then the borrower goes out and finds a property, and the home has to require at least $5,000 worth of repairs. Borrower is approved for the 203K mortgage, and the loan officer educates the borrower on the 203K program, including the complexities of taking on a rehabilitation construction project. I think in our experience, a lot of the problems come when the borrowers don't understand what they're getting into, okay? So the mortgagee reviews the borrower's form 92-700A in detail, so the borrower understands their responsibilities. And then the mortgagee, you select the 203K consultant to work with the borrower. Now, the consultant goes to visit the property with the borrower. You need to make sure that they're on the same page. So it's ideal, best practice, when the consultant goes out, the borrower goes out, so they both see the same thing at the same time. So the consultant visits the property with the borrower and prepares a work write-up and cost estimate. The consultant must also determine zoning and permit requirements prior to completing the work write-up and cost estimate. The borrower goes out and hires their contractor. The consultant provides the final work write-up and cost estimate to the mortgagee. Appraiser goes out and completes the appraisal. The loan application is processed, underwritten, closed, and funded, and submitted for endorsement. Then we come in, we insure the loan. The borrower or contractor must begin the renovation project within 30 days of disbursement and obtain permits for work that's going to be completed. So you have 30 days from closing to get started. Once the improvements begin, then the contractor completes the first phase of the project. The borrower and consultant, again together, inspect the completed renovations or repairs for completeness and compliance. Remember, you all want to be on the same page. The borrower, consultant, and contractor sign off on the workmanship, completeness, and compliance of funded work. The borrower, consultant, or contractor then submits the draw request to the mortgagee for review, approval, and funding. The mortgagee then disperses the two-party check made payable to the borrower and the contractor. Okay, and this process will continue until the work is completed. The mortgagee may approve up to a maximum of 5 draw requests. That would be 4 during the construction process, the improvement process, and 1 final draw. So a total of 5. Now, once the project is complete, the borrower contractor requests the final draw. The borrower provides a release letter indicating all the work is completed. The consultant verifies the completion and, if applicable, obtains a certificate of occupancy or building permit closeout approval from the local building authority, and any remaining escrow funds are released. Now, the mortgagee must complete the escrow closeout screens in the FHA connection. You have 12 months. On a standard, this process can take up to 12 months, and that's an increase from previously. It was limited to 6 months. So you have up to 12 months to complete the improvements. Now, what kind of improvements can you do? Right? That's probably the most common question we get. For the standard, some example of improvements include that if the borrower is using the existing foundation and it will not be affected, they can reconstruct the dwelling that has been or will be demolished. Or the borrower can fix a foundation if the dwelling will not be demolished. So either or, but there has to be the existing foundation there. I'm going to pause here and tell you a 203K success story. When I first came to the Homeownership Center, I reviewed a file. It was a 203K. Borrower bought this dingy single-family house. It had graffiti all over the walls. The floors were bare. I don't think there were any windows or doors on this property. They raised it to the foundation, and they put up 4 units in its place. So let's think about that. 4 units. They live in one, they collect rent on the other 3, and probably have never made their own mortgage payment since. So yeah, if that's not the ultimate in generational wealth, I don't know of a better example. I haven't run across one yet, but that is my 203 case ultimate success story. So what else can you do? You can repair or remove an in-ground swimming pool. You construct a windstorm shelter. Maybe not a lot of use for that in California, but you never know. You can install or repair wells or septic systems. And I think the most interesting one for everybody that I've come across is an accessory dwelling unit, an ADU. Now, what is an ADU? An ADU refers to a single habitable living unit with means of separate ingress and egress that meets the minimum requirements for a living room. And the ADU is a private space that is subordinate in size and can be added to, created within, or detached from a primary 1-unit single-family dwelling, which together constitute a single interest in real estate. Now, eligible ADU improvements include converting a 1-family structure to a 1-family structure with an ADU and 2 or 3 other units. You can add an ADU that will be attached to an existing structure, or renovate an existing ADU that is attached or detached to an existing structure. So let me go a little bit more in depth in this. Converting a 1-family structure to a multi-unit structure. The ADU counts as 1. So if you are going from a single family, you're going to build an ADU, and then you're going to add 2 or 3 units. That brings the total living units to 4, right? So that means you can't have the existing structure, 1 ADU, and 3 additional units, because that will make it 5. Okay, so be very careful if you run across something like this. Now, adding an ADU that will be attached to an existing structure. Okay, if you're building a brand new ADU, it has to be attached to the existing structure. Now, what do we mean by attached? It's not that the roof line's attached and it's not the common breezeway. The walls have to attach. So a portion of the wall of the ADU and a portion of the wall of the existing structure, they have to attach to one another somewhere, somehow. Okay, that's the criteria we're going to use. Now, if you already have an ADU, whether it's attached or detached, we're fine with that as long as the ADU is an existing detached ADU. We will insure it if you want to renovate it. If you have a detached garage with a single living unit, existing structure includes that detached garage. You can use the 203K then to convert that detached garage into an ADU because it's an existing structure. I hope I didn't confuse anybody more. I hope he just gave you more ideas. But if you have any questions, please let me know. Okay, so under 203K, all improvements to existing structures must meet and comply with FHA's minimum property requirements, MPRs. And they must meet or exceed local building codes. Now, for newly constructed additions to an existing structure, the energy improvements must meet or exceed local codes and requirements of the latest energy code standard that has been adopted by HUD through a Federal Register notice. Now, the current ones we are abiding by is from 2021. Okay, and you can find more information about that in the handbook. Now, there are specific standards for certain improvements that you're going to do. Any living area addition of a structured unit must be attached to the existing residential unit. That's what I went over. The property value must improve with any site improvements like landscaping, patios, decks, and terraces. The as-is property value must increase by the amount equal to the dollar amount spent on the improvements, or the site improvements must be necessary to preserve the property from erosion. So what can't you do? You can't put in luxury items. Okay, those are ineligible from the program. You can't spend any proceeds to finance improvements that do not become a permanent part of the subject property, or improvements that solely benefit the commercial function of the property if it's a mixed use. So some examples, right? You can't put in a swimming pool, hot tubs, saunas, and spas. You can repair or remove it, but you can't put in a new one. Okay? Satellite dishes, barbecue pits, fireplaces, on the outdoor fireplaces, things like that. And of course, you can't use proceeds for any to enhance the commercial portion of the property. Okay, the mortgagee is required to find an approved 203 consultant for a standard. The consultant must be selected from FHA's 203K consultant roster, which can be found in FHA Connections. Now, the mortgagee must review the consultant's actual work product and evaluate and document the performance of the consultant at least annually. If a consultant has demonstrated poor performance, Their services may not be used. The mortgagee must verify that the name shown in the 203 consultant certification matches the selected 203K consultant. Now, can a borrower do their own work if they're qualified? Should the borrower wish to act as a general contractor for the project or complete work on their own, they must be a licensed general contractor or have experience in completing rehabilitation projects. The mortgagee must verify and document their qualifications and approve their participation. On the work write-up, it has to detail what exactly the borrower is going to do. And the borrower cannot be reimbursed for labor. They can only be reimbursed for the materials used to make the improvements that they work on. Okay. The consultant must submit a cost estimate showing the cost for completion of each work item that the borrower will perform. Now, the cost estimate has to include the cost of labor and materials. The borrower, again, can only recoup the amount of the materials, not the labor. The borrower will also have to sign a rehabilitation self-help loan agreement to participate in the improvements. So what can be financed? The borrower can finance the cost of construction, repair, and rehabilitation, any architectural or engineering, professional fees for preparing exhibits, the consultant's fees as stated in the published schedule, reasonable and customary fees for inspections performed during the construction period, title update fees, permits, and a feasibility study if necessary. Now, there are unforeseen things that happen. Project costs, it's almost inevitable. So the program does allow a financeable contingency reserve to be set up. Now, the financeable repair and improvement costs are used to determine the minimum and maximum contingency reserve. And the contingency reserve is a percentage of the financeable repair and improvement costs. Now, the borrower, instead of financing, they can also bring in the funds to establish this contingency reserve. But of course, those funds will have to be documented in the appropriate manner. So how much? This is the table, and it's broken down by if the structure is less than 30 years old, or if the structure is 30 years or older. Okay. So this is found in the handbook, but it's a great reference tool for you. If they're going to finance a contingency reserve, there is a limit to how much they can finance. Now, mortgage payment reserves, right? Because if they can't live in the property while the improvements are going in, that means they're paying double, right? So when a property cannot be occupied during rehabilitation, a mortgage payment reserve amount can be set aside to make the monthly mortgage payments during rehabilitation. Now, the mortgage payment reserve may include an amount up to 12 months of the mortgage payment, which is the entire time frame allowed for completing repairs under a 203K. However, the reserve cannot exceed the completion timeframe specified in the rehabilitation loan agreement. If the agreement states the repairs will be completed in 3 months, the reserves may not cover more than 3 months mortgage payments. So here's the calculation. If you have a multi-unit property from which you could be collecting rents, but that you're not going to get, the reserves can only come for the units that cannot be occupied. So basically, if you have a 4-unit property with tenants living in 2 units and 2 units are uninhabitable, due to the renovation, you can only reserve half the total monthly mortgage payment for the building. Okay, so if you're going to do this, here's an example of the calculation, and again, you'll get a copy of the presentation for your reference. With the standard, a portion of a borrower paid origination fee can be financed. Now, the maximum is either $350 or 1.5% of the total financeable repair and improvement costs and fees, plus the contingency reserves, plus the financeable mortgage payment reserves. So what you do, both calculations, whichever is greater is the amount that can be financed. Okay, discount points. On a standard, a portion of the borrower paid discount points may be financed and the financing cannot exceed the amount equal to the discount point percentage multiplied by the total of the financeable repair improvement costs and fees, plus the financeable contingency reserves and the financeable mortgage payment reserves. So what kind of documents do you need? For the contractor, before the standard 203K case can close, a qualified general or specialized contractor has to be hired by the mortgagee. The general or specialized contractor must agree to complete the items described in the work write-up for the amount of the cost estimate and within the allotted time. Now, the qualifications of the contractor. The mortgagee is responsible for ensuring that the general or specialized contractor is qualified to complete the job. The mortgagee must ensure the contractor meets all jurisdictional licensing and bonding requirements and determine they are qualified to complete the project by obtaining and reviewing their credentials, work experience, and client references. You need to look at the qualifications for state license, if they have any current violations, if they have bonding or insurance, their work references, size of prior projects and types of improvements, and what their current work capacity is, because there is a time limit that they have to meet. So all these things have to go into the selection of the contractor. And that is the mortgagee's responsibility to make sure that they meet all these qualifications. Okay, what documents does the consultant need to come up with? The 203K consultant must submit required documentation to the mortgagee. That includes the work write-up, cost estimate, architectural exhibits, their consultant certification, and the consultant borrower agreement. The mortgagee must review the documents and verify that all health and safety issues identified were addressed before adding any elective work requirements. So anything having to do with minimum property requirements, health and safety issues, those are the priority. After that, you can look at, electives. So the purchase contract and amendatory clause. There are certain provisions that need to be in the sales contract for any 203K transaction. First, the amendatory clause does not apply on 203K. What does apply is the sales contract must address three things: a provision that the borrower has applied for a Section 203K financing. The contract must be contingent on approval of the 203K loan application and the borrower's acceptance of any additional required improvements as determined by the mortgagee. So those three items have to be part of the contract, even though you don't need the standard amendatory clause. So quick summary of the standard. Use the standard for renovations or repair projects with a minimum of $5,000. The standard 203K projects must use an approved 203K consultant, and all improvements must meet FHA's minimum property requirements and meet or exceed local building codes. So we're going to move into the limited 203K transactions. Okay, let's start with a quick comparison chart. The biggest difference between the standard and limited is that repairs exceeding $75,000 or structural repairs must use a standard. Limited is used more typically for minor repairs. Remodel the kitchen, new floors, paint, those types of things. As of November 4th, when the 203K program updates went into effect, that's when the rehabilitation cost went to $75,000. For those of you who are familiar with the program, you remember when it was limited to $35,000. And as someone who did a lot of deferred maintenance last year, $35,000 barely gets the guy out to look at your house. But prior to that, it had been $35,000 since 2005, when it went from 15 to 35. But you won't have to wait almost 2 decades for another change. The $75,000 limit will be reviewed each year when county loan limits are reviewed, and they will make a determination if an increase is warranted. So whenever we announce the new loan limits, that's when they would announce an increase to the rehabilitation cost limit on the limited 203K. So eligible improvements. It's designed for minor remodeling and non-structural repairs that, of course, don't exceed $75,000. It doesn't require the use of a consultant, but if the borrower would like to hire a consultant, they can hire a consultant, and they can finance the cost of the consultant in with their loan amount. That's a change that happened in November. Okay, so I mentioned that they'll be evaluating the limit for the 203K rehabilitation costs annually, and this just reiterates that. So what are common improvements? Eliminating obsolescence or health and safety hazards that violate FHA's NPR. Making changes to improve function and modernization. Connecting to public water and sewage systems. Repair or replace wells, septic systems, plumbing, heating, air conditioning, and electrical systems, and roofing, if the structural integrity of the structure will not be impacted by the work being performed. It also covers siding, gutters, and downspouts. When HUD sells REO properties, they pay for lead-based paint stabilization costs. If the borrower wants to pay for lead-based paint stabilization above and beyond what HUD pays for, they can include the costs in and use a limited 203K. Now, this guidance only applies to lead-based paint hazards for HUD-owned single-family homes constructed before 1978. As a reminder, violation of NPR and NPS must be included and addressed, whether you're doing a limited or a standard. So all improvements to existing structures must comply with, again, FHA's minimum property requirements, and they must meet or exceed local building codes. NPR violations are not optional or elective. So that's something to keep in mind. What's a major? You can't use limited for a major repair. So what's major? Costs more than $75,000, it takes more than 9 months to complete, requires more than 2 payments to each specialized contractor, if it requires the services of a 203K consultant to prepare work write-up, or requires plans or architectural exhibits, or prevents the borrower from occupying the property for more than 30 days. If any one of these apply, you cannot do the limited. You have to use the standard. So you have 9 months to complete the improvements on a limited. The borrower has to be able to occupy the property within 30 days. So even if it takes 9 months to complete, they still have to be able to occupy within 30 days. And you can only have up to 2 draws. Okay, so this is just what you can't do. I think by now it's probably going to sound very repetitive, but again, you can't convert a structure from 1 unit to 2, 3, or 4, or go in the other direction. If the structure's been or will be demolished, you can't do that. If you're doing anything with the foundation, you can't do that on a limited. You can't relocate a structure with the limited, and you can't make structural alterations. Now, this is not an all-encompassing list. We can't stress enough, it cannot be structural for a limited. Again, the borrowers can do the work if they are qualified, similar to the standard requirements. They submit a work plan. Each item that the borrower is going to be working on has to be identified. And if the cost estimate has to be prepared by the contractor, and it has to be other than the borrower, okay? The contractor has to be licensed and bonded if required by the local jurisdiction. And again, cannot include labor costs for the borrower. A contingency reserve may also be established, but is not required for 203K. It's at the mortgagee's discretion. Okay, so the contingency reserve on unlimited is the mortgagee's discretion. It can be financed in the loan amount, and it cannot exceed 20% of the total financeable repairs and improvement costs. So required on the work plan, the detailed proposed repairs or improvements must be provided by the borrower to the mortgagee in the form of a work plan. The borrower may develop the plan or hire another party to assist in the preparation. This may include the contractor or a 203K consultant. There is no required format. The work plan is an overview of the borrower's vision or ideas of what is supposed to be completed from the project. The work plan must be supported by the written proposal and cost estimates, which will be discussed on these slides. Okay. For each specialized repair or improvement, the contractor must prepare a written proposal and cost estimate. It's important that the nature and type of repair planned and the cost of each work item broken down by labor and materials be included in the cost estimate. The proposal and cost estimates must be submitted to the mortgagee for review. It's important to FHA that work items needing permits be identified in the written proposal. Also, FHA requires that the proposal indicate that the repairs or improvements are non-structural in nature. Structural repairs are ineligible under the limited program. It's a best practice to have each repair item specifically state permit required or no permit required, as well as this repair or improvement is non-structural. The contractor's written proposal and cost estimate should state specifically what permits are required and the estimated cost of the permit. For example, general plumbing permit, $250. So a quick summary of the limited program. It could be used for renovation or repair projects with a maximum of $75,000 in eligible improvements and cannot be used for structural repairs or major remodeling and repairs. Now, the rest of the slides are resources for your use. Again, I will be forwarding the presentation, so you'll have all of these for your references, for your reference. And I know I'm over, so I don't think I'll have time for questions unless y'all want to hang out for a few minutes.
Well, I can tell you from our perspective, if you have time, we are happy to. And I am sure that the people who can stay on will. Christina, I think we'll be coming back on as well. But why don't we start with because some of the questions are in the chat, but there's a few that ended up before I got the chat corrected. There's a few that ended up in the Q&A. So I'm not sure if you can see the Q&A. Esther, if you can't.
Yeah. Um, can an existing detached carport be turned into an ADU? If the carport meets the definition of a structure, yes. But I think the problem with the carport is that it doesn't have walls on four sides. I think that's a discussion we had. So right now, I'm going to say no, but I'm going to do some research on that one and follow up. Okay, this one about the project in Burbank seems to be a bit complicated. I'm going to save that for a written response. If they finance their payments for 6 months, but the rehab finishes early, what's happened? Anything left in the escrow account, once the work is completed and the final payments have been made, gets credited back to the borrower's outstanding principal balance. So it's not going to reduce their payment. Anything left over, any construction monies left over, anything left in the contingency reserves, that kind of thing, it gets credited to the borrower's outstanding principal balance. So if I can get a copy of these Q&As, that would be great. Our permits, okay, let's start at the top so I don't lose my place. Chat is working. Okay.
Yeah, so it starts at Ricky, so RC, right below my chat is working. It wasn't working originally.
Okay, right below my chat is working. Okay, you may answer this throughout, but I wanted to throw it out there. Are we able to pay off any debts to qualify or any cash out? No. If you do a 203K refinance, it's akin to a no cash out. Any cash to the borrower is reimbursements for out of pocket in relation to the renovation, or again, for materials if they did the repairs themselves. They don't get labor and they can't cash out. Okay, can the 203K be used with a reverse mortgage? No, it cannot. 203K is a forward mortgage product, and by its nature, reverse mortgage is totally different. So you can't intertwine them. Is an ADU counted as a unit? It is if you're doing a multi-unit project. Again, the original structure, you want to ADU and build 1 or 2 units, you're going to end up with 4 in the count. So the existing structure, the 2 new unit, or if you have an existing 3-unit property and you want to put up an ADU, that turns it into 4 units, 4 total living units, because the living units are counted all separately.
And I just want to throw out here, guys, that we'll probably go, a few more minutes, but some I see them being added as we go, and we're not going to be able to get to all of them.
Yeah, I have a couple more minutes. So
Yeah.
If your unit is a condominium, a true condominium, the project has to be approved, or it has to have a single unit approval, be able to get a single unit approval. That's the only way your condo unit is going to be eligible for any type of FHA insured financing. Can the 203K be used by an investor to purchase and rehab? No, it cannot be used by an investor. I don't know what you mean by what is involved for approval. If you can clarify that, maybe add that to the chat, and we'll answer it with a written response. Does the ADU have to still be attached? If it's an existing detached ADU, it doesn't have to be attached. If you want to renovate the existing ADU that's detached, if you're building a new ADU, yes, it has to be attached. If the initial purchase has a separate garage, are you saying that the garage can be converted into a ADU? If it's a detached garage, an existing detached garage, yes, you can convert that into a detached ADU. I know it's a little confusing. We were also very confused and had to get that clarified. As a licensed mortgage broker, can I originate my own 203K loan? The same rules apply. If you're an approved third-party originator and the lender that you go through underwrites and closes and will do the 203K loan, you can, the same rules apply as a regular forward mortgage. Again, can a limited 203K be used for, I don't know what a JADU is, like a garage conversion. If it's structural, no. And something, and
So
it has to come in, it
in
has to come in under.
California, sorry, in California, junior ADU is an attached ADU. So
Okay.
detached, and then a JADU would be considered a junior. It has to be an attached. So it's something attached to the primary structure.
Again, if the garage is an existing structure and it's detached, you can make it renovate it into a detached ADU. But whether that it can qualify under limited, I highly doubt it, because you can't do anything structural. So that would be the rub. Again, if it's structural, it has to go standard. I have to check on the recording because you guys post on YouTube. I'll have to check to see if I can do it. If you can, I can get approval to do that because it's YouTube. I will be sending the presentation out for that can be forwarded to you. Are 203K loans eligible for streamlined refinance after repairs are completed? Yes, they are. But again, has to be completed, has to be closed out in FHA connection. If that closeout is not done, you will not be able to get a case number on a new loan, whether it's to do a new 203K loan or to get a streamline. If they finance their payments for 6 months, but the rehab finishes early, can they still finance those payments? Again, it's financed in the original loan, all in the loan, and if they finishes earlier and they don't use all of that, whatever's left over gets credit to their outstanding principal balance. And I think that's it for me. If you can get me the list of questions, I will respond and send you the document. So I don't want anybody to feel slighted that they didn't get their questions answered. And I'm sorry I went over, but I hope you enjoyed the presentation and you got useful information out of it. So, but I want to thank you guys again for having me, and let's do this again.
Thank you very much. Appreciate you, Esther. Thank you, Jason.